much. This is our first panel. So I think it has to be provocative to inspire researchers and kind of wide-ranging, as opposed to very specific to, again, open the range of questions. So it's called Re-emerging After the Crisis, Growth Perspective and Financing. So really the main question we're going to happens after debt distress. Now, as you all know, following a long period with easy money, access to the bond markets, and we're talking about low and lower middle income countries, but middle income countries in general, access to Chinese funding, there was a period of growth and of convergence. And then starting in 2019, the sky fell and there was a series of negative shock, starting with COVID and then the war in Ukraine, food prices, fuel prices shot up, and then inflation, the fight against inflation, interest rates went up, the Eurobond market closed on many countries, interest rates went up. And suddenly, the developing world looked different. There were pressure on external accounts, devaluations, fiscal stress, increased poverty, and all that, and big questions about financing, adjustment, what to do. And so we're going to think about these. Basically, there seem to be three broad choices. Clean up the mess first. So massive debt reduction, forgive the old debts, won't have the same access in the future anymore. It's the end of a period. Fasten your seatbelt for a rough ride, do fiscal consolidation, wait for better days, they will come back. Or grow out of the problem, get new money, new investment, green growth, moving to trillions, this whole narrative out there. And so, we want to debate the possibilities and learn from the past, but also maybe in the second question, move to the current situation. I mean, can we expect the IFIs to finance new growth, to scale up rapidly? Is this going to be a systemic crisis or not? Are the market reopening? Is it the tail end of the crisis already? How do the heterogeneity of creditors influence things, the high domestic debt, which are different from the past, the geopolitical risks, and the like. So I am Ishac Diwan. For those that don't know me, I'm the Director of Research with the Finance for Development Lab. Also teach economics here, and I will moderate this wonderful first panel. So let me introduce you all first, so this is done. So we have up there Andrew Powell, Professor of Economy at William College. He has many positions in the past, like all of the panelists, but I've noted that he was Chief Economist of the Central Bank of Argentina. He works for several years at the Universidad de Tella, Buenos Aires. He was at the World Bank, taught at Harvard, at the Inter-American Development Bank, and he managed to publish many papers and several books while doing all this. Then we have Natalie Jaresko over there, who is now a managing director at Ernst & Young Parthenon Restructuring Strategy Practice. Natalie, also you have a career so rich as to make it too long to say in detail, but suffices to say that for today's purpose, you are the executive director of Puerto Rico's Financial Oversight and Management Board, 2017 to 23, and you oversaw the largest debt restructuring in U.S. municipal bond in history. And then you were Ukraine's Minister of Finance, 2014-16, and you restructured Ukraine debt, again, one of the largest deals, not the largest, because the largest sitting next to you. And you negotiated also the largest deal, of course, a wide-ranging IMF program as well. Yannis Manuelides, next, is the director at Elmar Advisors. You have wide experience in banking, finance transaction, including projects, corporate leverage finance. I say all that because you will talk, among other things, about project finance. Among many achievements, you led the legal team which acted for the steering committee of private creditors for the Greece restructuring 200 plus billion euros in 2012. Maybe that was the largest ever. It was, so far at least. Then we have Debora, uh, Revoltella, chief economist at the EIB. And in this position, you play a leading role in shaping the strategy, evaluating the results, and advising the bank on how to deal with rising indebtedness. And Starla, Griffin, who forgot to send me her bio, but I know her. You've occupied several leadership positions in areas connected to sovereign debt. You know the market very well. I know you're passionate about growing the green bond markets and helping us fight against climate change and transform at least the asset class into a green one. So welcome all. I'm gonna start with Andy. Hi, Andy. We don't see you very well here. Maybe you get us started, drawing from your recent book, perhaps. What can you say about life after death? Much's been written on earlier periods, so maybe you can be a bit more specific about the challenges in our world today, dominated by bonds, by China, and not by Paris Club and banks. So how to restart growth after debt restructuring. Floor is yours, Andy.
Okay, thank you. Can you hear me okay? I hope you can hear me. I'm going to share my screen and have a short presentation, so let me do that. I'm assuming you can hear me okay. So I'm going to talk briefly about debt reduction and restructuring in the context of debt reduction. First of all, let me say thank you for inviting me to be on the panel, and it's a real shame that I couldn't make it to Paris, so I'm missing you all, and I'm sure it's a great conference. So I'm very sad I didn't make it in the end, but happy to be here virtually. So you asked me before to put this in a more general context of debt reduction. So let me just say a couple of things about reducing debt, and this comes from a paper that Ugo, I think, may have presented earlier this morning, Ugo Penitza, and also in a book that Ishac referenced, which was published by the IDB last year. So reducing debt is never easy, and prevention is clearly always better than cure. So it's best not to get into the problems of high debt in the first place, and I'll come back to that. If you look at actually how countries have reduced debt, the debt reduction episodes, largely they've been driven by inflation, often assisted by financial repression and low real interest rates. So that's not normally the recommended course of action, but that ends up being the more popular course of action, perhaps because the other course of actions tend to be rather difficult to put into place. There are episodes which are driven by growth or by fiscal adjustment, but they are relatively rare. Now, one of the new things we discovered about the inflation episodes is that they tend to be with more moderate inflation, not with very high inflation, and also with independent central banks that can keep interest rates low. So I think that speaks to trying to retain monetary credibility through a consistent monetary policy framework, which is as important as a consistent fiscal framework. So I think that's important to bear in mind. So notice I haven't said anything about debt restructuring as yet. So what we found was that debt restructuring is frequently associated with a debt reduction episode, but it's very rarely the main driver of that debt reduction. It is in some cases, especially if you include the HIPC MDRI countries, and perhaps if more recent low-income countries will be included in the future. But in general, you don't find debt restructuring as a main driver of the debt debt restructuring as a main driver of the debt reduction episodes. So debt restructuring has not actually been that successful in reducing debt, which may seem surprising. But it's not that surprising when you start looking at the universe of debt restructurings, which are, of course, quite different. There are many ways to restructure, because the majority of debt restructurings are actually reprofilings with no nominal haircuts. So, of course, that doesn't reduce debt. And the only way that debt to GDP goes down is then if growth picks up. And the other point is that reprofilings maybe, I mean, we tend to think that they can be relatively fast and relatively painless compared to other restructurings, at least, and pretty sure that they are. But after reprofiling, the probability of needing another restructuring is relatively high. So many times reprofilings are followed by reprofilings, and in fact, multiple restructurings are not that uncommon, particularly among reprofilings. So it's also to bear in mind, success is not just getting a deal, but success is actually stimulating growth and reducing debt in the future, which I think is why this panel is particularly interesting. So if one looks at the impact of debt restructurings on debt to GDP ratios, what you find is that for reprofilings, which is the blue line, debt goes up before the restructuring, and then it comes back down to more or less where it was about 5 years after to 5 years before, the same level as 5 years before the reprofiling. Whereas for debt reductions with nominal haircuts, then the debt reduction seems to be much more significant. Now, there's been quite a bit of empirical analysis of debt restructurings, and it's a big caveat is in order, because often these are descriptive results and they depend very much on the samples that you choose, and also a lot of methodological choices. For example, here we've included all restructurings, not just final restructurings, but many people only look at final restructurings. And of course, if you look only at final restructurings, you do tend to get different results. You basically get rid of this problem of restructurings. So that's something to bear in mind. And if you look at growth, well, growth tends to recover before the restructuring, and it tends to be a bit more sustained after a restructuring with a nominal haircut compared with a restructuring with a reprofile. And that, I think, I suspect, is because there is continued uncertainty about whether you will need a reprofiling in the future. So how to understand these results? Well, I think countries face a choice. As I mentioned, reprofiling is generally considered to be less painful, but then there's a higher probability of a restructuring, or with a significant nominal haircut, which is normally associated with greater delays, more pain, potential legal problems, and so forth. So, of course, boosting growth in either scenario is quite difficult. I think the new generation CACs were an advance and may well help, but of course they're only relevant where you have a country that is essentially where bond debt is the dominant form of debt. And as Ishac mentioned in his introduction, we now have considerably greater creditor and instrument diversity, and I think that only aggravates the kind of choice that countries face going into restructuring. So what can countries do? Well, the first advice, of course, is to maintain good fiscal frameworks so you don't get into this problem in the first place. So preventative measures, and use financing very wisely. As Ishac mentioned, there's a considerable plethora of choices of financing these days, not just the traditional bond market, but many other sources of financing. So, of course, take the best deal, take what's on offer, but really select projects very, very carefully, and that's the main first piece of advice. Maintain, of course, good relations with creditors. There's other work to say that actually is particularly important. And I think another lesson from previous restructurings is that restructuring is not enough. Complementary reforms are required. Particularly complementary fiscal reforms can be very, very important. And I think Jamaica is an emblematic case of that, which had the first debt restructuring in Jamaica was 2010. They went on to restructure debt several times, but the debt restructuring is often considered as one of the most successful, but largely because of the complementary reforms that went alongside the restructuring. I think be transparent about prospects and maintain conservative projections. I think there's a sort of tendency to be over-optimistic about what debt restructuring will accomplish and then what the outcome will be in terms of growth and so forth, and then that may lead to less generous terms. I think, unfortunately, the international financial institutions are sometimes a party to that. It's hard to retain, to be conservative. There's a sort of natural tendency for optimism, perhaps too much optimism. And then think very carefully about growth, which is very country specific, but try to find a growth strategy that will work. And don't have time to go into that, but perhaps in the discussion. What can the world do? Well, the common framework, I think, had a great potential, but unfortunately, it's been painfully slow. It's kind of suspect that global politics has bogged down what you might think of being more pragmatic advances. Meanwhile, while the common framework has been bubbling on, there have been several restructurings, of course, outside of the common framework. There were 5 in the region that I know best, which is Latin America and the Caribbean, Argentina, Barbados, Belize, Ecuador, and Suriname, all with their particular challenges, but also with a lot of interesting innovations in each of these restructurings, which I think there hasn't been enough attention on the innovations that have been taking place and collecting the lessons learned and then applying them for the future. I do think that a regional approach might find greater common ground and more pragmatism and perhaps avoid the global politics, and so ease progress. And I think that's worth thinking about. And my last point is, as Ishac mentioned, I think scaling up climate swaps could bear fruit, but the details are very important. And to make sure that they're really a good deal for countries, and they're also an efficient use of donor capital, which I think we should never take as a given. We should also always analyze the detail of these transactions to ensure that they are meaningful and a good use of funds. So I will stop there because I was told to be very short. So thank you very much. Thanks.
Go for the difficult choice of debt reduction. You know, what were the? I'll give you this one. What were the costs and the advantages?
Thank you very much. So I look at this from the perspective of the policymaker sitting, having to decide what to do next. And in the case of Puerto Rico, in the case of Ukraine, to some extent, there really was no choice. In Puerto Rico, let me say the common element between both of them is that as the policymaker, I was certain that we were facing insolvency, not illiquidity. And I looked at reprofiling as a solution for illiquidity. It'll work its way out over time. And restructuring, reducing the nominal amount of debt as a requirement for insolvency. And so in both cases, I looked at it as a restructuring was a requirement. But in both cases, very, very different in terms of the choices that we had. In the case of Puerto Rico, it's a territory of the United States. It does not have the right, it is not a sovereign, it does not have the right to negotiate as sovereigns do, nor does it have the right as a normal municipality in the United States to file for bankruptcy under U.S. bankruptcy laws. So a special law was passed by the U.S. Congress, which enabled it to access the U.S. bankruptcy system as if it were a municipality, but only with certain access, with certain rules very specific to the law Promesa that was adopted in 2017. I think that that law allowed for us to have not only a bankruptcy-like environment, but it gave us an ability to have an automatic stay. So we were protected from all of the creditor litigation, all of the challenges that would have been very difficult. It would be the pain, I think, that Andrew described earlier. And Puerto Rico was able to avoid that pain because as soon as we entered into that process and filed in the court, all of those cases were stayed. And we had the time, we had the benefit of time to work through the bankruptcy, although it's extraordinarily complicated. If I had to compare the Puerto Rico bankruptcy with its sovereign restructuring, the US bankruptcy system is just much more complex and it's much more legalistic, and lawyers are the ones that typically win on that. I would say that having that choice for Puerto Rico, though, was critical because they had at that point to choose between paying their debts or reducing essential services. There was no access to capital markets. There was no way, in this case, the creditors were not willing to voluntarily do a haircut. And so only with the help of the US Congress were we able to enter into bankruptcy and then negotiate what was in the end about a 50% reduction in the $70 billion of debt. And we had a $50 billion unfunded pension liability that we had to deal with in shutting down, in essence, all the public pension funds that were bankrupt. And I can tell you that shutting down the pension funds is almost more complicated than negotiating with creditors. And you move from publicly funded pension funds to basically 401ks, self-financed, because the government is not in a position to provide for the pensions anymore. And that's a shock to the system. In Ukraine, similarly, it is in my view at that time, and I'll give you, in both cases, creditors disagreed with my position. In both cases, creditors insisted it was in insolvency, and in both cases, they insisted on reprofiling. But in Ukraine, we had just been invaded. So in 2014, the initial invasion of Crimea and then Eastern Ukraine, the economy was collapsing. We had poor governance before the war, so it didn't begin with the war. The poor governance really was what caused this to collapse so quickly, and what the difference is between today with the full-scale invasion and the economic situation in Ukraine compared to 2014-15. The currency devalued by half. About half of the banking system was insolvent and holding much of our domestic debt. And the national bank, the central bank, had approximately 1 month's import coverage in currency reserves. There was literally no way for us to cover what was estimated to be a $40 billion balance of payments deficit over 4 years. So we needed an IMF program. We could not do this on our own in any way. We could not cover that balance of payments gap. And the IMF program came with certain requirements. And those requirements, in essence, were, yes, the IMF will provide $17.5 billion, but you have to have a debt restructuring that will reduce that balance of payments gap by $15 billion. We had a specific target in our IMF program. And then the other creditors, the other partners, the G7, the EBRD, and others would provide another $7.5 billion to cover that $40 billion gap. And each of those pieces were required, or the whole picture fell apart. So in the case of Ukraine, we had to get to that $15 billion balance of payment savings through a haircut, through a extension maturity, or we would not be able to stay in the program. And we were facing a default in September of 15. So it was either reach an agreement, regardless of at that point whether or not all of the terms of that agreement were perfect. They were not perfect. They never are perfect. Or fall out of the IMF program, which is the good housekeeping seal to all of the other G7 creditors, all of the other parties. And then in the midst of war, you're on your own. And that was an impossibility for Ukraine at that time. So negotiating that haircut, we were in a sense supported to achieve the haircut by the IMF requirements. But from another perspective, as a negotiator, it was clear to the creditors just what I had to achieve. So I had no leverage to do better. They knew exactly what the numbers looked like. And as soon as we hit that 15 billion, they were like, okay, that's it. No matter how much I wanted to do more, that wasn't going to happen. So it was a combination of these elements, but in both cases, it really was an insolvency issue, which requires, and I'll leave it at this, what Andrew said, which is then really for it to be successful, you have to figure out how to grow the economy, how to grow your economy, and what kind of debt management policy you're going to put in place, not to repeat the mistakes that led you into this crisis. And I could talk about that at another time.
Yeah, we'll come back to that. Very interesting, your distinction between insolvency and illiquidity. I mean, at FDL, we've been also making it, but it's contested. But I guess when you're insolvent, you know that you're insolvent. It's more when you're illiquid that one can ask whether you're really illiquid or not. And Yannis, this is somewhat a question for you. I mean, when we look at Southern Europe today, a few years ago, they were all over indebted, about to explode. And then they went different ways, right? Greece went that restructuring, reduction way, Spain and Italy did not. And so very diverse experiences, yet today, seemingly, they're all growing very fast. So, you know, how do you assess the choices they make?
Okay, well, thank you. And thank you for having me. I do not know that there is a single story for Europe. I would add Ireland to the story, but especially if Brad Setzer is in the audience, I will not dare say anything more about Ireland. You will explain us all why Ireland is now second in Europe after Luxembourg on GDP per capita and purchasing power parity. I think Spain and Italy probably sort of different stories. Greece and Portugal were the ones who struggled more because they had difficulties both with their fiscal position and their banking system. And they have both, I think, fared in a slightly different ways. And I think Portugal has fared better. Their numbers are the GDP, debt GDP is better for them. It's first of all, let me just say on where everybody ranks on GDP per capita PPP, because that is actually purchasing power parity is actually the kind of, for me, and a very important indicator of where sort of relative sort of wealth of countries. So the EU average is 100, the Eurozone average is 104. Portugal is 83, Greece is 67, just followed just narrowly by Bulgaria. And Luxembourg's on top with 240. And Ireland is 212. Netherlands 130, Denmark 128. So it just gives you a perspective of the vast differences here. Greece was not allowed to do a haircut the first time around for reasons that are complex and we can discuss, but it wasn't. Instead, it got this massive loan from the Eurozone, which is still there, in a way plays a very important role, and I'll speak about this in a second. But its debt GDP is 162% now at the end of 2023, down from 210 at 2021, I'm told. I hope the numbers are correct. And Portugal is at 99%. But the interesting thing is that if you look at how they differ on current numbers, and for me, this is kind of the more significant going forward. It's the current account and the budget deficits. And Greece's current account deficit at end of 2023 is 7.5%. Before the year before 9.7%, before 6.8, whereas Portugal had a surplus of 1.4 in 2023, and small deficits the 2 years before, 1.4 and 1.1. And the fiscal deficit in Greece is again continues to be high, whereas Portugal has surpluses, even small surpluses. And Greece also remains high on unemployment, 11.8 compared to 6.5 Portugal. So for me, these headline numbers basically tell slightly different stories. And I think part of the story may be that Greece did not take advantage of the shock the way Portugal did. And if, I have a sort of a list of what I would do, after the shock. But I did go to Portugal during the crisis. I was invited by the Portuguese Parliament to speak to them, and I remember how well they all worked together. I'm thinking this was a common problem, and I never once saw that in Greece. They were all kind of trying to stab each other in the back. The Portuguese, I think, owned the program, the IMF program, or whatever program they had. They were told they owned it a lot better. They conversed with it. They developed it. The Greeks never did that. But also Greece was not allowed, as I said, to do the haircut initially, and it didn't take full advantage of the shock. And it's now, in a way, a ward of the Eurozone because it has the bulk of the debt. The principal repayments are postponed until 2032 or 2034. There's some sort of accounting tricks about whether sort of deferred interest is counted or not counted as debt. It's going to appear at some point. And the only reason really, market access is smooth is because the amounts are small and they all have shorter maturities than any of this massive Eurozone debt. And this is a well-known problem because the Eurogroup mentioned, specifically Greece in 2018, they said that don't worry, guys, if by 2034 your gross financing needs exceed, I think, 20% of GDP, we'll be here and we'll readjust the thing so that you can always manage. But that's a sort of tacit acknowledgement that, there's a big problem in the future and sort of coming up. And as to growth, yes, you are right, there is growth. Countries started from a low position, of course. But I think, again, it's important to note that a lot of this growth is due to the to non-market inflows, money, huge amounts of money from the Recovery and Resilience Facility. Certainly for Greece, I think it's 30.5 billion. That's massive, and it's basically non-market money that's not necessarily allocated and policed the way market investors would want to police it the way multilaterals or EIB would police it. If I'm you can correct me if you disagree. So it's not as if this is not doing something. Of course, it's doing, but whether it is going to all productive ends as it should, I do not know. I hope it does, but. And I'm not. This is not a criticism for basically the government, or I think the government is doing as good a job as it could. It could. You can always criticize. It can also do better. But I mean, they're broadly doing the right things. I think it's just that the position is fraught because of this overhang. And principally because, unfortunately, Greece, because of these two elements, namely principal inflows for investment come from Europe, huge reliance on that, non-market, and principal debt holders are, again, Europe, non-market, and they're shielded from basically market pressures, which I think, is not a good thing. We can discuss about what else they could do or what a country should do on recovery and whether Greece has met that. But I'm happy to talk about that if you want.
Right. Thank you. Well, that reduction by itself doesn't resolve the deep root causes of the problem. At least we learned that.
Well, in Greece's case, we didn't have debt reduction from the beginning, and we didn't have because. We were in the middle of global financial crisis. A lot of the stock was held by European banks. There was a huge fear about European banks already. The world was discovering European banks had subprime exposure. They were only just discovering it. Nobody really knew what was there. They didn't really know what exposure to Greece was. They also did not know remember the scare of the CDS, the credit default swaps. They didn't know what the indirect exposure of European banks was through writing CDSs. And I think the IMF was, and I know some people are here and they'll have to say, but basically they introduced a rule just for Greece, which I took back a few years later, saying that, okay, well, if it's not sustainable with some probability, then we'll we won't insist on the haircut. And they gave this massive amount of money, but it's basically to safeguard, I think, the global banking system. I have views on that. I think Greece could have exploited that in negotiations afterwards. I mean, I've actually, with Daniel Cohen, we presented a paper some years ago on just that. And they didn't do that. So Greece is really unusual because they didn't really do a proper haircut. And that showed that even after the PSI, when you have 75% sort of haircut, the new bonds traded at a deep discount. The market basically didn't believe that was enough. So it is an unusual situation. I also would like to say that just generally Europe and all of Eurozone countries, I don't know how much we can use them as examples because of the common currency and because of all the support mechanisms that I just mentioned.
Well, I mean, let's talk about the support mechanism. In all cases, MDBs, IFIs play a crucial role of bringing new money into a difficult crisis situation, sometimes requiring, as in the case of Greece at the end, debt reduction before they come in so that there is a chance of them coming out whole. But the more interesting case these days is what the IMF would call the gray zone countries that are not clearly insolvent and that we could call illiquid. And so, illiquid countries, you want to really help them grow out of their problem, come back to the market. But there's this big risk. Debora, you'll tell us about that, about MDB funding going in and leaking out and ending up bailing out the other creditors, potentially in a situation of insolvency, actually, or in a very long liquid situation. So, how are you dealing with that at the EIB? What's your view on how to support countries today, given that leakage that we see in the figures?
I think you make a very interesting specific point. I take it a bit larger and then come back exactly to the question that you are making. And actually, I really start larger in the sense of explaining a little bit what the EIB is, because a lot of people I was talking in the various coffee break were telling me like, but are you also active in emerging market and developing economy? And I was saying, yeah, you don't know it. So the EIB is the World Bank, if you want, where the shareholders are European member states, is a treaty-based institution. And we actually have in our mandate to operate in Europe and out of Europe, where out of Europe is at large emerging market and developing economies. So we don't have a specific exclusion, but of course we wouldn't go in the US, Canada, or Australian developed economies. And in what we have lending activities around. It has been growing. We have an ambition for further growth. We are around 85 billion euro lending per year. We are planning to go around 95 billion euro. And out of Europe, so the perimeter out of Europe, last year we were lending us on 8.4 billion. And like in Sub-Saharan Africa would be 2.5 billion, and the rest divided among the other countries. We are also very active in Ukraine. I think there we really stretched ourselves in the sense that in the moment of crisis, Europe was trying to put together a package for Ukraine. It was very difficult, the European approval. We had an undisbursed loan project base that we made whatever possible to take out every conditionality to pull the money in the countries, and we are still quite supportive and trying to lend. That's generally on the institution. So yes, we are present. We are present lending in emerging market, developing economy, low-income countries. We are a project-based institution. We don't have a budget financing, and that's create us some little criticalities in moments in which you have to guarantee even a time of debt restructuring or post-debt restructuring, net positive flows. We have been very lucky in the past, particularly in the case of Zambia. We had a project we could continue lending, but if you don't have a project and you have to continue to show net positive flow, it's difficult for project-based institutions. So we are also thinking, because we have very committed in continuing to support countries in debt distress with net positive flows. We are even thinking at a new project program developments, and now we are thinking at sector-based lending, where you can have a sector-based and not a specific project-based. So the project may have problems because of I don't know, the bridge there is a law that has to be passed, etc. So we are trying to find other ways to remain supportive. And I think compared to what you were saying before, the beauty of an institution like us is also very much that every project has to pass ex-ante validation, ex-ante assessment of the economic rate of return, and quality assurance in all the way of the project. And I think that's very important. We are an atypical institution as well, because we have a group of some 600 engineers in-house. So it's very useful because we really have the technical competence on top of the technology, also at the European level, and the same engineer, they can operate wherever in the world. So in fact, it's really a transfer of the top technologies all over in the world and then being adapted. But there is, the engineers are not divided between Europe, dealing with the European market or dealing with out of Europe, are the same technology knowledge that is being played out. That's the big digression at the beginning. Then where do I see the challenge for institutions like us? I think we had a lot of discussion already today and also in the various sessions on where do we stand in terms of debt situation. I think I'm very much convinced that we are maybe more it's a liquidity issues in many, we are not at the same level in low-income countries, same level of debt that we had at the time of EPIC. We are actually much lower level of debt, but the real concern is really in terms of the debt servicing cost. And a lot of the debt that was taken at very low rate is now being renegotiated. So the debt servicing part will really become one of the main challenge in many of the countries. So as an institution, we are thinking more of how to manage somehow the debt servicing, reducing somehow the debt servicing cost rather than reducing the level of debt on our side, maybe also for the kind of institution that we are. And particularly because we think that there are a lot of not only specific development needs in the countries, but there are a lot of also world public goods where we want more investment to happen. And the world public goods is really the climate transition, the huge investment that we expect to come. So we are looking at a number of new products and actually experimenting and trying to implement. I think on the one side, we have been looking at increasing, trying to look at the concessionality of our loans, also in terms of the concessional element we bring in the project. We have looking at the maturity and the grace period that we can apply to projects, and we have a new facility where we can go to maturity of normally 20-25 years with long grace periods, but we have also the option of 30 years with a 10-year grace period. And that's what we are trying to develop more. We benefit from a guarantee from the EU Commission as well, so it's not only the EIB, but we are rolling out in new projects this element, which increases the level of concessionality, if you want, that we bring. We are also looking at another example of a new instrument is a debt for climate swap. I think we are quite proud and speaking a lot about it. We have a new program in Barbados that is being put in place. In fact, Barbados can issue debt structured as a sustainability-linked bond or sustainability-linked loan, and that is backed by $300 million guarantee, half coming from us and half coming from the Inter-American Development Bank. And then with the savings in terms of debt payment for Barbados, they can invest in a project that we agreed that is the South Coast Sewage Treatment Plant. So in fact, they have, through the saving in terms of the cost of debt services that they get through our guarantee, they can act in terms of climate goals. And the other thing that we are looking at is climate resilience debt clauses. Again, we will implement also in the case of Barbados one of these climate resilience close. It's on the public sector. I understand that it's much better to have also the private sector involved, but actually we look into this new scheme. And the other thing that I wanted to mention is in all what we do, I was mentioning our lending. Our lending is not only to the public sector, there is a lot of public sector financing, but also what we try to do is really to have the leverage effect, so catalyzing the private sector. And I think when we talk about debt issues, that's extremely important. So everything that you can do as an institution in creating guarantees and creating a mechanism for de-risking the private sector and having the private sector entering into countries at high risk, I think that's really something that we plan to do as institution. Of course, and I come to your point, the issue of is your financing as NDB just allowing somebody else to get out? Hopefully no. Hopefully no for an institution like us. Like I'm thinking in the case of Greece or other projects, we really try to be project focused, project finance. So we do the projects, and we do projects that are investment projects that should we look for increasing the potential output, etc. So being project based, it's less of a risk. But I think it's very important to make sure that this doesn't happen.
Yeah. Thank you, Debora. Lots of food for thoughts. I think we're going to be talking about swaps and clauses, and that issue you concluded with. I mean, this is Chatham House, right? You were keen on that. But if I may, David and Dee, I don't know if you're around, if I may repeat what you were telling me in the case of Kenya, where you wait impatiently for disbursement from EIB or the IMF to repay the bondholders or China, and not much of this is sticking at home. So it is a very serious problem. We need to keep talking about it. So to kind of go with the wind and offer more concessionality, helps not increase the debt, but it doesn't help countries grow out of that. And somehow we need better burden sharing, and it's a difficult question about how this can be achieved, but let's keep that on the table. While moving to the last issues we want to put on the table, can take this, which is Starla. So we have the impression that, at least for frontier economies, we'll never be back to 2010, where the market is inundated with liquidity, and that this bond, this Eurobond class, if you like, sovereign risk is ending somehow. It won't be as much as it was. And so, while we can reprofile and prolong the payment over time, the big hope is to move to another class, to a green class. And so you've been kind of a passionate advocate of that. Tell us, how realistic, how fast, how are we moving to this new clientele? Is there a clientele out there?
Great. Thank you, Ishac, and thank you so much for the invitation to speak here. I'm going to go back even a little bit farther, a bit like Debora did, before I come to the present moment, which is, since we're talking about life after debt, post-HIPC, post-MDRI, when we had all of the developing world basically with clean balance sheets. Then what happened next? Essentially, the global financial crisis is what happened next. And what should have happened after HIPC, MDRI, what was promised and what didn't, I don't really think come about, was a lot of support for countries and a lot of new financing that could have been maybe perhaps a new kind of financing that could have brought about a different outcome than the one that we have today. But instead, I remember well, and I referenced this remarks made in Washington a few months ago, corresponding with about the run on Northern Rock Bank in the UK. We were holding a large conference on what was it called specifically? it was financing development in sub-Saharan Africa, post-HIPC, what role for the private sector? We had gathered together many financial institutions, banks, bondholders, African finance ministers, IMF, World Bank, to talk about what this new financing should look like for these countries. We were, the private sector was arguing, oh no, there needs to be a lot more market finance available for these countries. They need to be able to learn to like borrow well on the capital markets and then invest in the countries will grow. And the World Bank and the IMF were saying, whoa, be careful. Maybe we should look at, other types of more conservative or maybe use of proceeds at the time. And this is back in 2007. And everyone was like, money is fungible. How can you have use of proceeds? That's ridiculous. Needless to say, not much happened because of the global financial crisis and then this retraction of particularly Western institutions into the developing world. But then in stepped China with a lot of project finance in particular. And, a lot of the developing world and a lot of in sub-Saharan Africa, there was growth. And I think some of you were in the China discussion this morning where that might have been highlighted. And then we had as a result of the financial crisis, quantitative easing. And then all of a sudden, there was all of this money available in the developing world because of a search for yield. But this was just pure credit. So all of a sudden, we have a lot of money available for these developing countries, but there was no consideration of what that money looked like, what it was used for, nor was there any support for the debt management offices of these countries, many of which had become much smaller and less sophisticated than they had been pre-HIPC, when they had been very, very used to dealing with the Paris Club over many years and through the whole HIPC process, which was really quite reform intensive and a really, really, quite a sophisticated process. So that brings us now to where we are today, which is, many of these countries borrowed too much. They then are hitting, financing walls. A lot of this was, 10-year debt. So all of a sudden, it's needing to be refinanced in an extremely difficult interest rate environment for these countries. And that's where this question comes: what next? Are we going to do the same thing that we did last time in this crisis? Even if it isn't, people will say it's not the same as HIPC. It's not. But there are a lot of similarities in terms of the inability of these countries to move. They're stuck. There's leakage, net outflows, and there's very little growth. And at a moment where there are many crises that are kind of hitting at once. So now to be provocative, and because we're talking about debt, I want to ask this question, and hopefully by the end of tomorrow when I have to leave, I'll have a little clearer sense of it. When we talk about debt and debt restructurings, what do we want? Because what I'm about to say is that we need more debt innovations. And people who knew me before Ishac, like Yannis, know that I'm actually very interested in sustainable instruments, not just green instruments, although I would say I would put them in that context. Why? Because it attracts a different type of an investor, one that might have a longer term, longer horizon, and have their interests more aligned with the country rather than just being yield seeking, which is what our current cohort of investors in frontier markets usually is. And essentially, we need new instruments to attract these investors. But what does that do? That makes restructurings much more difficult. Okay. And everybody this morning, I've heard it. I know it's going to happen like throughout the conference. We're going to be talking about innovative debt instruments, and then we're going to be talking about how much they complicate restructurings. So do we want to complicate restructurings if we have a debt swap, if we have a sustainability linked bond, if we have green bonds? Maybe not, because they're more project based. But do we want to encourage these innovations, attract these new investors, have credit enhancements, change the asset class or diversify the instruments and the investors available to the emerging markets? or the developing markets, thereby complicating some eventual restructuring? Or do we want to say to ourselves, by changing the investor base and inviting in these debt innovations, we are trying to switch the paradigm and make restructurings less normal? I mean, frankly, they're not that common. If you really want to look at the horizon of restructurings, they're not that common. So do we want them to be easier, or do we want the type of financing and the type of investor to be of a higher quality and a greater benefit, particularly for growth? So those are some questions I would pose, hoping to be provocative, as I was invited to be.
Yeah. No, I really like that, because, when we think about this, so I can call it a debt crisis, even though it's not a full-fledged debt crisis. Now, the question for us is, what is its character, in a way? All these crises are different. The Latin crisis and later on the African crisis were about something very clear. It was the end of import substitution, state-led development on the one hand, and bank lending, petrodollar using on the other hand. So it was really the end of that particular period. So we moved to another doctrine on development and other instruments out of banks, basically. And then the Asian crisis has its own character. And so when you ask what is today's character, it's less clear, because yesterday we were debating African debt, and there are three types of countries, it seems. There are countries that borrowed a lot and mostly consumed and ended up in bad shape, kind of category one. There's category two of countries that borrowed and invested, maybe long-term, then were hit by terms of trade shock. They were unlucky. And so they have a debt problem of a different type. They don't need to reform as much. They need to recover. And then there's a third type of country that borrowed a lot, invested, grew, and doesn't have a debt problem. The debt to GDP ratio is low, actually, because they grew a whole lot. There's much more diversity than before. There's no unique story. If there is a unique story, is that what we'd like to see, the sources of growth are not as clearly export-led as before. We would like them to be much more green. The support for development is much more coming from the green side. So it's kind of your side that is what's specific about this. So maybe it's emerging out of this crisis. We want to try to go in this other path. Look, there are two things we could do. We could go to a second round, but I want to show of hand to see how much demand there is for question from the room before we do that. 1, 2, 3, 4. All right, let's go to the room. How about that? We can always come back to our second. So how do I do that? You can start with Anna and then move up the room. We take 2, 3 questions at a time.
Thank you very much. Anna Gelpern, Georgetown Law. I want to pick up on Starla's last provocative observation and ask what makes for the kind of new sustainable investor that you want to attract. So immediately 3 possibilities came to mind. A yield-driven investor, good old-fashioned yield-driven investor de-risked by the public sector. That's one possibility. Possibility number 2, public sector creditor motivated by strategic or charitable or other non-financial objectives, or a private creditor configured, regulated, guaranteed to be a long-term investor like a bank, which is, of course, also backed by the public sector. So are we really just talking about financial engineering with public sector in the back, or something else? Thank you.
Thank you. Very good. What kind of animal are these long horizon investors?
Yeah. My name is Chayo. I'm from a Frontier Research, which is a macro firm based in Sri Lanka. My question is too broadly to the panel, but does touch on the Greece-Portugal example in specific as well, in terms of contexts where incentives for policy measures can be more tied towards, let's call them perhaps against the structural adjustments that might be required to use that term, but in the same context can attract the debt sustainability side from the opposite perspective. So my question is, what kind of incentive balancing can happen in these contexts, and how do those incentives differ, and how does it affect the ability to move into, to grow more moving ahead?
You're talking about financial instruments?
Not any form of kind of the incentives within the, let's say within a polity, within a society, within the policy measures, the economy, the participants therein, whatever it is.
Let's take one here, or you wanna one more and Avinash.
Good afternoon. Avinash Persaud, formerly Special Envoy in Barbados, where we did a couple of those debt swaps, and now at the Inter-American Development Bank. I would say on debt swaps, by the way, that they already are much more marginal than a lot of people appreciate. A very specific niche, but we'll probably talk about that in the next session. The thing that really confounded me a lot in my years in Barbados was why there isn't more restructuring. The world has a lot of debt. A lot of countries are struggling to issue new debt at unsustainable rates and yields. They really ought to be restructuring, but there are clearly lots of obstacles to them doing that. They're very reluctant. Is it fear of the IMF program? And I'm not talking about public debt, so the private creditors. They're fearful, I think, of going into an IMF program. I think they're fearful of other things. How do we make a world in which, where there is an insolvency problem, that we actually do the right thing and restructure?
Thank you. Let's do a round. Maybe Starla, start with you, and then we'll come back.
Great. Thank you. So yeah, who is this? Who is this new investor animal? This is a really good question, Anna. And we've seen them come to the surface with some of these new instruments. We've seen them come into the debt swap markets. We've seen them come in the SLB, the sustainability linked bond market. So where if you speak to Uruguay, I don't know if all of you have been lucky enough to come across Herman Camil, who is the head of the Uruguay DMO. They issued a very successful sustainability linked bond some years ago. They retapped it, and now they have also accessed a World Bank sustainability linked loan. They managed in the first, and I think it's 1.5 billion that they issued in their SLB. They managed to open their accounts to, I think, up to 20 or 25 new accounts in mostly Europe and Asia, who are primarily ESG/impact investors. So they have mandates to enter and to purchase these types of instruments, replacing the yield investors. This is our new animal. And yeah, you do need to incentivize them through regulation, or you need to, incentivize them, through regulation, and sometimes with credit enhancement. But sometimes the regulation will do it. They have mandates to put certain amounts, and you also have shareholder activism, which is extraordinarily strong. So this animal does exist, and the other thing that Uruguay did, which I think is just a fantastic idea, they issued the SLB and they used the proceeds, because it's not like a use of proceeds bond in the sense that you have to use it for the specific project. You can use it for a number of policy and other initiatives. They used it to purchase back their expensive debt from their traditional EM creditor. So they got, a number of benefits from doing this, and they will evangelize for the SLB. Now, it's not an easy instrument to issue. It took them over 2 years to put everything in place. But in doing so, they improved their governance, they improved transparency, data, interministerial cooperation. They had numerous externality benefits from issuing this. So, but there is another thing that I don't think we'll have time to talk about today, and it is the issues on the supply side, the capital supply side, and ODI. Just shout out to ODI. Just came out with a very good paper, as did Vera Songway, with some partners that we represented from the because I also represent the Children's Investment Foundation. Looking at barriers to capital flows out of the developed world into the emerging markets. And aside from this ESG push, it's extremely hard to open up this spigot of pension funds, insurance funds, et cetera, to get them into this market.
Really shareholder activism, regulation, and public money at this stage.
Yeah, exactly.
Yeah. For the second question.
Okay, so if I can also partly answer Anna's question. I mean, we can discuss it, of course, at great length, Anna, but ultimately for me, there's always a risk of public money. The question is how many layers in between you put. And public money will always be involved. And in fact, just central bank policies, ultimately also involve public money and transfers of wealth. And so let's not, there isn't anything which is, the question is how remote you get, what layers of risk you put, and how transparent you are and all that. So that I think is very important. And I don't know whether we're going to come to project finance, but I very much believe in project finance. EIB does proper project finance. And you can there introduce several layers of risk taking precisely before you can call the state to come in and support. Now, again, we can come back into project finance if we have time. I know it's part of my sort of preset questions. But coming to what a country could do, I do not know that there is, again, a single answer. And I don't know there's a single set of incentives. I think what I would start with is I would start with trying to see what, first of all, making sure that after the restructuring, my banking sector is alive and well. Because one thing that we keep on talking about large projects, but no economy can work without SMEs. And if there's no banking system to fund these SMEs, you're really you're dead. It isn't going to go anywhere, and that's extremely important. So your banking system has to be able to work well. You have to make sure the SMEs can operate with simple laws. Easy entry, level playing field, easy exit. I mean, it's not the mantra is well known. The details, of course, difficult. You need to focus on make sure that you need to see what your strengths of your economy are and focus on tradables. And I think to me, what's also very important is to look at two things that sometimes we miss. So debt sustainability analysis is always a creditor instrument. It tries to determine. I'm sure I'm going to be corrected by Sean or others here, but even for the IMF. But it tries to determine how much debt can be repaid, and because sovereigns don't have a proper balance sheet, it doesn't show some return on equity, and that's what's basically growth is. And I think what I would want to start with is to see the country have its own DSA that it uses, working with the IMF's DSA, but basically focus on what its equity is and see what its return would be based on its strengths, and then next to it, try to see what assets it has. Again, a country doesn't have a balance sheet. It doesn't have an asset side, but it does have tons of assets that it usually misprices. It privatizes for nothing, especially in time of crisis, and it doesn't develop them well. And again, a certain type of project finance, by which I mean, sort of, you identify the asset, the project or whatever, and you try to develop it long-term to see returns in it. And trying to do that for the assets of the state would be very important. So that would all depend on assets, but also it would depend on what sort of proper governance rules you can put on that. And various countries, I think, are trying to do that. It's not easy, but the asset side of a country is actually very important. And so that's I would very much look into this in the context of a modified DSA, the way I explained it.
So I'm going to answer your question in a very different way, in a very micro level. And to some extent, it answers your question as to why we avoid the IMF programs and then, the debt. I think our IMF programs are written in a way that requires the bare minimum of structural and fiscal reforms, which are painful. And after you have a debt crisis and a debt restructuring, you have an opportunity of a lifetime to take that moment and reform. Because everyone understands how complicated it's been, that you've just saved yourself from falling off the edge of the financial cliff, that the debt restructuring may put you out of the capital markets for a time. So you really have to do something. And as a reformer in a government, you have a very small amount of time. And if what you focus on is the IMF program, you'll have an even smaller amount of time because those are painful. And what we need to start doing is pairing those difficult reforms with I look at it as the incentives to do those things. So I'm going to give you just a couple concrete examples. In Ukraine, one of the biggest issues we had was that we had subsidized natural gas. And that subsidy was in essence causing a $10 billion deficit at the state-owned oil and gas company. And it was creating a marketplace where in fact, we were subsidizing the most wealthy that use the most gas, whether that's industry or wealthy large homes, but we weren't, we were subsidizing those who didn't need a subsidy. Raising the gas prices by 465% in one day in a country that uses a lot of gas in the winter is extremely painful. If instead of that being the requirement prior to that had been to set up an appropriate social system of subsidies for those in greatest need that included, for example, a cash card for the savings that you could create if you used less gas over that period of time, and you could actually use that as an incremental amount of spending on something else. If we had done that first, if we had put that means-tested system in place first, and then increased the gas prices 465%, that is the human element of that reform would not have been so painful. Industry still would have screamed, but they could scream all they want. They needed to pay market price. When the IMF tells you to raise the price, they don't tell you about that other part. The World Bank might come and say, maybe you should be doing this, but it's not ever timed properly. I'll give you another example, which is in Puerto Rico, we needed to cut costs. There was a fiscal deficit. We needed to reduce. Puerto Rico has a balanced budget by constitution and no access to debt. So you look at the largest spending entity, and that's, for example, the Department of Education, and you have a major change in population. Population is declined substantially. You don't need all the schools that you have. In addition, transportation has changed over the last 60 years since these schools were built. We can now take a bus from one community to another with very little problem, which you couldn't do previously. There were no roads. So you have to shut schools down. Shutting schools down, I did it in Ukraine and I did it in Puerto Rico. It's very painful. It's a necessity. It's the right thing to do, but it's very painful. If before you shut down the schools, you identify areas where you can create new hub schools and you can put resources into that hub school, and you can tell a parent, yes, I'm going to bus your child. However, your child is now going to go to a better school that has computer labs, that has language labs, that has, multiple grades with multiple classes without having, 4 kids in a classroom. And you can assure them that there will be a bus and that the road is paved, which requires enormous interagency cooperation, which is not normal. It's not just the Department of Education all of a sudden. Now it's the Department of Transportation. Now it's somebody else. It's the local government with the buses. If you can do that before you shut down the schools, it's a completely different reform. But we always focus on the hard part without focusing on the part which would seem like an incentive. And to some extent, I think that's why people avoid IMF programs, because the IMF programs are the hard part. And even as a reformer who I believed in our IMF program. I helped write it and I believed it. We could only do it while we were in major crisis. As soon as we got to like 2% GDP growth, nobody wanted to reform anymore. That's enough. Don't rock the boat. That's enough. This reform government should go bye-bye, and we're now going to be okay. We're going to be right here because it's painful. And if you can't balance that pain, if you cannot provide incentives at a micro level to do these things, you'll never have the ability to continue the program. And then you end up repeating all your mistakes of the past.
Can I just add something to this, because you can see points 1 and 2 here. Yeah, and two here. But I mean, you know, getting owning the IMF program doesn't just mean doing the IMF what the IMF wants. It's actually doing what you've just said. And the IMF will never, ever, ever know exactly what and how this needs to be done, because they will come with, you know, big sort of headline economic solutions that, you know, are necessary, but they will not know enough about the country, and they will have a lot of arrogance about their correctness of their views. And you will have to kind of not fight back on the substance, but fight back on the implementation and actually show a proper implementation like this. And I think this is very important.
I'm going to give you one more example just to prove how insane some of this is. Yeah, of course. Sorry. Ministry of, again, Department of Education, this is now Puerto Rico. You want to reduce your largest cost category, which is salaries, but you really don't want to reduce the number of teachers per se, because also the outcomes in education are so poor. If you actually look at how they're spending the dollars, if you actually have everyone come in and actually put a face to the payroll check, you find that 20% of the payroll is going to people who are dead, off the island, and or retired. They just kept paying them. That 20% can be applied to people who actually need an increase in pay. But it's, when you just cut 20%, right, you're cutting everyone who's actually working, and you're cutting the incentives. And so really how you make these reforms and how you think about your problems is really critical.
Do we have some more? Yeah, I'll go back to Andy. Do we have some more questions? Okay, one here. And Debora, I want to ask you a follow-up question, as if someone could send the microphone up there and then here. Okay. Well, let me then not ask my follow-up question. Okay. You, and then we go up there.
Okay. Good afternoon. Thanks for the presentations. Really interesting. My name is Mike Seiferling. I'm from UCL London. So my question's a little bit of a curveball, but follows off of what was just said. Why are we not attending Balance Sheet Con? So why am I asking this question? Because a lot of the focus here is on the asset side. And we have the Monetary Capital Markets Department at the IMF doing a lot of work these days on like the ALM framework, asset liability management. Why aren't we bringing these together? Why do we sit and only talk about one side of the balance sheet and kind of leave the asset side out, but then talk about growth, which is produced by the asset side? So I'm confused by why we're so obsessed with one side of the balance sheet and we ignore the other one. Thank you.
Okay, let's go up there. I'm not sure we're not talking about the asset side, but all right, we'll talk more about it.
Okay, hi, my name is Merveille Paja from Bank of America. So first of all, thank you for your remarks, but also I like the point on making distinctions between insolvency and illiquidity issues. I guess my question is a bit more general. So, I mean, at least in the asset class, I would say that the feedbacks we're hearing from investors is the need to have more innovative instruments. Again, I'm talking about the like of value recovery instruments, but also what is also be called as SCDI. So maybe it applies for Ukraine or different restructuring in general. But the question is, what is your view there? Do you think that it could be useful going forward? At least from what we hear, different clauses or more covenants will be welcome by investors. But again, I understand that there's always the need to maintain, obviously, the good relationship between the authorities and also the private sectors, right, to be able to reaccess the market when needed. So yeah, that would be great to hear.
Thank you, Sophia. Andy, get ready. We'll get back to you in a moment. Not yet.
Thank you very much. My name is Anaí from Flaxo University and Sudamericana Visión. I have a question on IMF ownership. So I really like this approach of thinking about debtor, in a way, owning the program, but it being the responsibility of the debtor country in a way to truly kind of think about it and bring the ownership into it. But at the same time, I was wondering what the IMF could do from the kind of policy perspective to try to encourage procedurally IMF ownership of the countries. And I'm thinking, for instance, about how to develop the exceptional access criteria further. Thank you.
Thank you. We go there. I mean, we're getting question on many things, but this is the opening session, so there'll also be discussions in many other sessions.
Hi, Simon Henriksen, University of Copenhagen. I think this is for Starla. I was wondering if you would be curious to your view on all these green instruments that we're thinking of. What happens when we start to test the purpose, or money is reallocated and we actually need to take these to the courts?
Andy, you can pick assets, VRIs, IMF rules, court cases.
Okay. Thank you. Can you hear me? So I want to start with the liquidity versus solvency discussion. I'm getting a terrible feedback, but I'm just going to assume everything's okay. I mean, I think I didn't mention liquidity versus solvency for a reason, because I don't generally like that distinction when we're talking about countries. I think it all comes back to the infamous DSA, debt sustainability analysis, which, as we all know, is very difficult. It's you can in many cases get the answer that you like depending on certain choices that you make. At the IDB, we used a whole suite of different debt sustainability analysis methodologies, and then we would sort of compare between them. They wouldn't always give the same results, and in the end, a lot of judgment calls are required, and a lot is also dependent on what you think the future actions are going to be. So sustainability depends on the commitment to future adjustment and so forth. So it becomes very difficult, and there's a huge gray area. I mean, I agree, you kind of know when you're grossly insolvent, that's clearly true, but there's a very large gray area. I think we need to think even more about how to do DSAs properly. And I think this relates to kind of this discussion also about the cost of restructuring and so forth. So Avinash said, why not having more restructurings? I mean, I think he's right in the sense that, restructuring is not easy. I think it's costly, so countries avoid it. It's costly for many reasons. There are domestic costs. It's hard even just to, separate domestic debt from external debt. There's a lot of domestic residents that hold foreign debt, and foreigners that hold domestic debt. And then I think Yannis mentioned the financial system issues that could be involved. So it's very, it's a tricky situation. And I think one thing that this comes back to is how countries choose their debt structures. I mean, you want to, and I think there's been a huge improvement, by the way, in general in debt management, which is, I've been positively surprised actually by how many countries have fared during a recent period of high interest rates. I agree that higher for longer could cause problems as debt is renewed at higher rates and so forth. But to date, I think many countries have managed the situation very well, precisely because they've had better debt structures. And I think the debt structures themselves can also help reduce the cost of restructuring. In general, making sure your asset classes are well defined and you know exactly who your creditors are and how they would be restructured. It's sort of a living will for countries, if you like, or going at least in that direction. And then that comes to Starla's point. I mean, I do think there is a danger of new instruments creating restructurings being more difficult, but at the same time there are new instruments which could make restructurings more avoidable. So state contingent instruments hopefully reduce the need for debt restructuring, but at the same time there are definitely some instruments to be avoided. I mean, I think there are some recapture kind of clauses which should be avoided, such as step-up clauses on bonds which are restructured, which I think have provoked restructurings in the past. I think all recapture clauses ought to also have negative contingencies, in the sense that so it's fine to recapture if GDP goes up or a commodity price goes up if you're a commodity exporter, but at the same time then then payments should go down if GDP growth is less than expected or commodity prices fall if you're an exporter. So there should be a true state contingency rather than just simple recapture. And finally, I agree completely about the point on the asset side. If you look at the IDB flagship book on dealing with debt published early last year, you'll see that there is a section looking at debt management strategies, which also incorporate assets and how to think about incorporating assets. So stop there. Thank you.
Well, thank you all. Look, I mean, I think clearly there are maybe most questions are on the table and many answers already provided. So thank you very much to the participants and to our panel, and the conference moves on.
Thank you.